What's up, y'all? Welcome back to BMX TV. We thank you for continuing to subscribe, and we want to bring you a great piece here on PE ratio and how you can use that to compare companies that you're looking to invest in, as well as companies within a sector and industry. So a PE is simply price to earnings ratio. So that's the price of the stock next to the earnings of the company. Now the earnings is the net income of the company. So they might have their revenues, which are up here, but they're going to have all their operating costs, their taxes, any other expenses, etc., etc. So whatever is left is going to be their net income. When you divide that net income by how many shares the company has, you're going to get their earnings per share. So you divide the stock price at whatever it is at that time, divide it by the earnings per share or the EPS, you're going to get a PE ratio. Now, a PE ratio is simply known as a multiple. So it's if you take the earnings per share and you multiply it by whatever the PE ratio is, you're going to get the stock price, hence the multiple. So anytime you hear on TV or if you hear business people talking about, oh, the company's multiple, we built it on a multiple, that simply means that the price that people are valuing the company at compared to what the company's actually making or worth. So you can use this PE ratio when you're comparing companies, particularly within an industry or a sector, to find those hidden gems. So say, for example, let's use telecommunications company AT&T, Verizon, Sprint, and T-Mobile. Now, back in the day, Verizon, AT&T, and Sprint seemed to be the breadwinners, particularly when Sprint had Nextel. And everybody was having one of those. T-Mobile was kind of like this new little thing that came along, kind of like when Metro PCS came along, and now you got Cricket, which I actually think is owned by AT&T. But anyway, T-Mobile came along and their PE was either going to be very little because they just didn't really have anything, or the PE was extremely high because it could have been overvalued compared to what the market is. So let's say in that telecommunications area, their average PE ratio was 20. That means 20 times. So let's say if all those stocks were having an EPS of $1, their stock price would be $20 per share, so their PE ratio is going to be 20. Now let's say T-Mobile, which earns about $1 per share, but their stock price is at $40, their PE ratio would be 40 because the stock price is valued at 40 times what the company's actually earning. So a lot of times, now real quick, a lot of times in the technology sector this happens because people are they're so innovative. They're always trying to do the next thing, find out the next big thing. So people are willing to invest and take those big risks because that big risk could bring in a big reward. Now back to it. So now we have an industry average of a PE of 20, and we have T-Mobile who has a PE of 40. Now the goal is you want that PE to come down, because if that stock price were to remain the same, that means that their earnings is increasing. So instead of T-Mobile earning $1 per share, once they earn $2 per share, now their PE is going to be at 20. So that means that if T-Mobile has a PE of 20 and their stock price is 40 while everybody else is sitting at $20 a share, then that means that their net income and their earnings per share is actually twice as much as those other companies, and T-Mobile is now finally in the game. So you want to try to use PE to find companies and compare them to others. You want to find those diamonds in those.
I took you out of Jacobs and clusters, busters. They wanted to rush us. Love the way you sparkle when the sun touch you.
You know, those hidden gems that you can capitalize on. So a low PE could mean that a company is undervalued, or it's just, you know, nothing going on. And if a PE is actually equal to the book value of a company, that means that the company is just fairly even. Example of that would be Xerox. I think that their price per share is about $14 or $15, and their book value is $14 or $15. So investors don't really have any upside because Xerox is just Xerox. It's going to do what it does. You know, it's going to continue to do printing supplies, companies, whatever. But when you have a company like Facebook and a Twitter, their PE values are going to be skyrocketing. Their PE values are going to be like 70 and 80, when most companies, most safer companies, have a PE around in that 15 to 30 range, because over time they're making more and more money, so it's helping out the company. It's making them look better. So you don't want a PE that's too small, but you don't want a PE necessarily that's too large unless you're in tech. You want to try to find that company that, if that PE is too small or too large, is this company on its way to get towards that industry average? Everybody's going to buy into all the well-known companies. Everybody's going to buy the AT&T, the Verizon, the Sprint. But what's this little lagger T-Mobile doing over here? You know, these whales are over here getting in all these main companies, but what the sharks going to do is they're going to try to find these small companies and get in so they can have a bigger profit. Recently, Southwest did something similar. You had companies like Delta Airlines, American Airlines, United, and they were all, you know, the main companies doing well. And here you had Southwest, who was kind of coming up. Southwest was chilling back in, what, $20 a share or something a couple years ago, maybe even just a year ago. And all these other companies were at low 30s to mid 30s, and here comes Southwest. Now Southwest is equal with the rest of them. They're all sitting at about $40, maybe a little bit more per share. So Southwest came on the game, and all those investors said, you know what, I'm not going to focus on those super duper airlines like American and Delta. I'm going to look at Southwest, who's not a super small airline, but they are still up and coming, particularly with that Wright Amendment that just went away back in October. Now Southwest ain't got those stops, particularly here from Dallas to anywhere. So your PE value is definitely very useful. A lot of analysts use the PE value or the PE ratio to compare companies, also using it to see how well a company's doing. If a company's PE ratio is at 60 when you bought it, then you notice after a year it went down to 50, then the next year it went down to 40, then it went down to 30. If the stock price is staying the same, that means that company is earning money. Now, the stock price could be fluctuating, which most likely it should, but you always want to compare what the price is doing in increasing or decreasing compared to what the earnings is doing with increasing and decreasing. And you don't want that PE to get too low, but you want it to be at about right, which, as I mentioned earlier, is about 15 to 30. So thank you for tuning in to this episode on PE ratio. We hope that it'll help you in terms of using it for your research and your strategy. It's not the only tool that you can use, but it is a very useful tool, and a lot of investors use it.